All right, everybody, thanks for tuning in. My name is Chris Stout. I'm the owner of Stout Capital, and today we're going to go through what is a limited partner. What is it like being a limited partner? How do you become a limited partner? How does it all work? So let's get that like and subscribe out of the way now, and let's get started. All right, what is a limited partner? A limited partner is a position in an ownership that you are limited. You're limited in your ability to make decisions, but you're also limited in the amount of work you have to do. So typically there's a general partner and there's a limited partner. The limited partner typically are the people who put up the majority of the capital. You're the money guy. You're the person who puts in the money to get the deal done. The general partner is the person or group of people who go into a deal. They find the deal, they put it together, they go through the miles and miles of endless amounts of emails and phone calls that are necessary to get these deals done, right? There is high competition in good deals. There's tremendous amounts of money out there, hence why limited partnership works so well. There's more money than deals. So deals throughout the country are limited. That's why so many people put their money here in the United States. So there's more money than deals. Limited partnerships work great because there's more money than deals and there's less people that want to put the deals together to actually get them to happen. So general partner, limited partner. Limited decisions, make all the decisions, have to deal with the tenants, don't have to deal with the tenants. That's the best way to explain it. So financially, how does it work out? Let's get into that. Okay, Chris, how did you get started in this? Why did you become a general partner? How did you get people to invest with you? I'll tell you. What we did is we started development. I actually started as a developer in Staten Island building 1 and 2 family houses. And what I would do is I would get past clients of mine who I've remodeled their house for or done some type of work with or built them a house with their money. I wanted to become a spec builder. I wanted to build houses to sell. When you build a custom house for somebody, which was my main business prior to development and prior to this, you develop a very deep relationship with people. They know what you're about, they know what you do, they know your honesty level, they know everything about you. So I've taken past clients and turned them into investors. We use their money to develop property in New York. So we were building 1 and 2 family houses with these investors, and we would provide a very good return, but it was usually short. 1 year, 18 months. We would give them their money back and they were like, oh great, what else you got? And development isn't a very fluid thing, meaning we could build a batch of houses, then the next deal could take time for approval, it drags on a little bit, there's not a deal in the pipeline. Whatever it is, we wouldn't use our investors' money all the time. But what the investors did know is whenever I sold houses, earned the money, paid them back their handsome return, what happened after that? I went to go buy apartments by myself. So we were doing this a bunch, and I had some investors saying, hey, we want more. We want our money to go longer. We love that you give us a great return, but we don't want our money back so fast. We want it to continually work for us. So it was some of my higher net worth clients that know that your money working for you is very important. It's very popular in the middle class, lower middle class, that everyone wants to hold their money. Higher net worth people know they have to send their money back out to keep it working. So they said, hey, Chris, we know you develop properties, you make good money doing it. We know you put your money in apartments after. How do we get involved with that? And a light bulb went off in my head. My initial impression was, no, you're not getting involved in that business. We keep you in the development side and I get the apartments for myself. And what I realized is, what a greedy mindset. What a greedy mindset to keep all the apartments to myself. When I was younger, I thought the way to true wealth was a bunch of 2-family houses in New York that would kick off a couple $1,000s a month in rent, and I would be able to do anything I wanted with that couple $1,000s once the loan was paid off. All of that is terrible. You don't run your properties out to have no loan on them. You don't not scale and pay them down. That's not the way to make money. So a light bulb went off. If I go bigger, I could get these investors involved with me. So let's do that. Let's start looking for bigger property. We go after a 16-unit property in New York. Get people involved in that. Wonderful. everything's working out swimmingly. Say, you know what, let's go out of state. There's better opportunity out of state and the returns are more insured. Why are the returns more insured? Well, in the southern states that we invest in now, they allow us to operate a real business. They allow us to operate a business where if someone doesn't pay rent, they're able to be evicted. We make sure that we keep all the right people in the building. I can control what the building kicks back. In New York, we're not really able to control it as much. We're pushed back so much on laws and rental laws and landlord-tenant laws are impossible. I said, you know what? If I invest people's money, I have to go to a landlord-friendly state so we could be in control. And that's exactly what we did, and it's working wonderfully. So that's how I got started in being a general partner. Started in development and moved it over to the apartments. All right, let's get into the nitty-gritty now about what it's like being a limited partner. Okay, what is it like being an LP? How do I get involved in being an LP? What do I do? How do I get into it? What is it? Perfect. Being a limited partner is an ownership type position where you're limited. You're limited in your decision-making abilities, but you're also limited in your responsibilities. The general partner is the person who's in charge of making all of the decisions and doing all of the work. So we're talking to the property manager, we're dealing with the broker, we're lining up the deals, we're doing endless amounts of emails, paperwork, putting the whole deal together, getting it funded through the bank, all the stuff that it takes to get a real estate transaction closed, we do it. Everything that it takes to run the real estate transaction, we take care of. Being a limited partner is a wonderful position to be in because it allows you to take advantage of the 100% of the benefits that real estate provides. It allows you to take advantage of the tax depreciation. It allows you to eat the cash flow. It allows you to take advantage of the appreciation in the building. All wonderful things. And a wonderful thing about limited partnership is it protects the limited partners against one another. So when you get into a limited partnership, it's very typical that you don't know or have a relation with the other limited partners. So most real estate insurance, most partnerships could go bad because partners don't agree. In this partnership, you have nothing to worry about. Each partner is limited in their ability to make decisions. So you're getting involved with a general partner who you're interested in doing business with and you think could make the right decisions with your money. But the other partners in the business have no ability to screw your position up. So here's a little pie chart that I drew, and this is my 100% ownership pie. So this entire pie represents 100% of the ownership in a real estate deal. 30% of the deal is carved out for the general partners. That's how we make money. That's our incentive to get this going. 70% is reserved for the limited partners. So the limited partnership could then be cut up into investor 1, investor 2, investor 3, investor 4, and investor 5. If we need $5 million to get a deal closed, $5 million, this guy could potentially be $1 million. And this could be a multitude of different amounts. This guy could be $100,000. There could be 10 $100,000 checks, a $500,000 check. We keep going until we add up to $1 million. Essentially, $5 million. We keep going until we add up to $5 million. Essentially, there could be one limited partner that puts in $5 million, and that would give him 70% ownership of the deal. That's usually the best way that I like to describe it. If you were to give 100% of the money necessary to close a deal, you would own 70% of the deal, and we would retain 30% ownership, again, for doing all the work. Here's one caveat of the transaction. We put a preferred return for our limited partners. So our preferred return typically hovers between 6 and 8%. For this example, let's use 6%. If a deal earns a 10% return, the limited partner would get 6%, and then the 4% would get cut up 70-30. 70% of that would go to the limited partner, 30% of that would go to the general partner. The better we do, the more money we make as general partners. So then we'll put what we call a hurdle. A hurdle is a place where the 70-30 now changes. So if we were to get you to say a 15% return, After a 15% return, we would split it 50-50. So it behooves the general partner to get the limited partner as much money as possible. The higher we go, the more leverage it is in our side. It's very interesting to us to get the deal to make as much money as possible because that's the amount that we're able to share in these transactions. Okay, Chris, why do you put general partnerships together? How come you just don't buy real estate with your own money, smaller amount of real estate, but you're a whole owner? You own the entire thing. I'll tell you why. Because no matter how much money you have, you could always run out of money. Jeff Bezos would not be able to buy all of the real estate in the country. Neither would we, neither would anybody. It always has to be a group of people. Real estate is a team sport. So why do we get involved in bigger deals and pull investors aboard? Because it's a scalable business. We're able to do this now as a business. This is no longer a side job. A lot of people own real estate as a side job. They own a 1 or 2 family house. They deal with the tenants. One tenant moves out, 50% of their tenancy is gone. Most of us start like that. So what happens? You want to scale. This is what you want to do. You don't want to make real estate a side job anymore. You go into this business and you're able to scale. We could continuously buy. For as long as people invest money with us is the amount of deals we're able to buy. It should be an endless thing. Very scalable business. This is what we like to do. Now you're investing with people who are professionals. We do this for a living. We analyze deals for a living. That's what you're doing as a limited partner. You're taking your money that you would love to put into real estate, but you don't want to do it yourself. You give that money to a general partner who wants to do it as a living and does it as a living and has been doing it for a long period of time, have seen a lot of deals through and through. We invest your money into real estate like you've been wanting to do forever and never pulled the trigger. So there's nothing wrong with owning real estate completely and wholly by yourself. But if you've been saying it for such a long time that this is what you want to do and you've never done it, it's a great option to put it into a general and limited partnership. You put your money in, you get all the benefits, and you don't have to do anything. What's better than that? It's definitely better than putting your money in the bank, and in my opinion, 100 times better than putting it in the stock market.